is Patrick Tan, as our host so kindly introduced, and I'm the CEO and General Counsel for Novum Alpha, which is a digital asset quantitative trading firm. And I also double up as the head of Super Crypto News, which is Asia's leading cryptocurrency and blockchain publication with the key markets in Vietnam and Thailand. Okay, so Nate, thank you for joining us. Maybe you tell us a little bit about yourself.
Sure, thanks for having me. I've been with Bancor since late 2017. I work on growth and increasing adoption of the Bancor protocol. Prior to that, I was a financial analyst and journalist in some large publications in the United States. And then also prior to that, and around that time, worked on mobile development in a lot of technology startups. And yeah, I've been in crypto since about early 2017 and with Bancor for, let's say, coming up on 4 years now.
Okay, great. That's nice to know. Thank you for that introduction. So I think today what our viewers and the people who'll be tuning into Chain Plus would really be interested to listen to more about is, I understand Bancor has to do with decentralized finance. We know that that's a really hot topic. And I like to understand, there's this concept of automation of DeFi, but I think let's ease our viewers into it a little bit more, one step at a time, because for those people who are just dipping their toes into cryptocurrencies, the whole idea of DeFi might be like, really out there. So let's ease them into, tell me what you understand by decentralized finance.
Yeah, sure. So a lot of people have bought cryptocurrency at this time or are thinking about cryptocurrency. And the idea of DeFi is that you can actually do something with your cryptocurrency. You can make it productive. So instead of just sitting inside your wallet and collecting dust, you can somehow maybe lend it or provide liquidity or stake it, as they say, just place it in a smart contract and have it used to perform financial transactions. And you can earn interest, so just passive interest, from lending your assets or providing your assets for this purpose. And the idea is that we can automate a lot of financial transactions just by allowing the liquidity or the infrastructure to be powered by sort of people instead of going to a bank and having the bank control how your assets are lent out. There can be a sort of public infrastructure where people can provide their assets or stake them, and then other users can access that financial infrastructure to take some action. Maybe it's borrowing the assets or maybe it's trading, and you don't necessarily need a bank in between. You can do it with code, and you can do it in a way that no one owns the infrastructure that's powering these transactions. It's sort of accessed like a public good. So, the idea is that anyone can access, as a user, as an end user, these this financial infrastructure, and that anyone can also get yield or passive interest using it. And the fact that you don't have a middleman, or in this case, a bank that's involved, there's kind of really two key benefits there. The first is that it is censorship resistant and resistant to centralized control. So there's not a single entity that can sort of change the rules of the system or really even shut the system down. It just runs on its own, fully automated. And also, when you have fewer middlemen involved, both sides can effectively earn more money. The side that is performing as an end user a transaction, so whether a trade or borrowing, they can get better rates. And also on the other side, the person who is putting up their capital to have it used for these types of actions can get better returns on their assets without having a middleman involved to extract a bunch of fees.
Well, I think, just on a logical conceptual level, I think most people can understand that, with DeFi, it's sort of like, you're getting a communal decentralized bank. Everybody's a bank, sort of. Everybody contributes to these smart contracts. But I think, how about for those who wonder, yes, the smart contract can do the execution and the securitization portions of the loan, but what about in terms of securing your counterparty risk? So For somebody like, let's say myself, for instance, let's say now if I were to put into a DeFi smart contract, how do I know that the person on the opposite end will necessarily pay? I know the smart contract code does preserve certain things, and generally most DeFi smart contracts are over collateralized. So, but what if I didn't want to, what if I was a borrower and I didn't want to over collateralize that loan? How would that work?
Yeah, so I'm focused mostly on trading, so I can really, just answer your question from the trading perspective, and that's where in traditional finance and a lot of, let's say, order book based models, where you're essentially being paired with a trader or a buyer or a seller on the other end. In DeFi, you're actually trading against a piece of code and against a pool of capital that exists on chain. So how much capital it's all fully on the blockchain. So you can see how much capital exists in this contract. And then the contract, really based on the amount of capital that's in its reserves, can determine the correct price to offer it to you at. And this is the kind of innovation of automated market makers, that they can know the price that's being offered by external markets, and they do so through a third party that's involved, that's not affiliated with the protocol or not affiliated with the end user or the provider of capital, but they're another party called arbitrageurs, and they're essentially profiting off of balancing the prices that are offered by the automated market maker with the prices that are offered by a centralized exchange, and ensuring that these automated markets stay efficient, and that the prices being offered to, let's say, an end user, in my case, a trader, or it could be a borrower, or even a lender on the supply side, are efficient and in line with external markets. Now, if you are more of an institutional user and you don't want to take smart contract risks, there is a whole middleware solutions that are launching that allow institutions that don't want to just use a MetaMask and don't want to place their tokens in a smart contract. So there's whole middleware solutions that are agreeing to take custody of your assets, and really providing an ability for more institutional, more risk-averse parties to access some of these really high yields or some of the trading that occurs in decentralized finance. And if you're, even worried beyond that, there's all these insurance solutions that are launching that allow you to take out insurance, smart contract insurance. So, say there's a hack and some of the money is withdrawn, or you end up losing money, then these third-party insurers can actually cover that insurance and ensure that you get reimbursed for any thefts that might occur against these decentralized protocols.
No, that's great. Speaking of high yields, because you brought it up, so I think one of the questions that often comes up is where do these high returns or these yields that you get from farming? You hear about triple-digit APYs, and we all know like the return on a deposit, the average return on a deposit in the US is 0.06%. So how are we able to get these sort of yields even on dollar-based stablecoins? I believe you can get about 7%, 8% per annum at times. So where are these yields coming from? Because obviously somebody has to be paying, for this.
Yeah, so I would first caveat this, that as a user, you really do have to be careful. A lot of the contracts can pull you in and with 10,000, 8,000% APY. And really a big part of what Bancor offers is more realistic and reliable yields, because what ends up happening as a user when you see these massive APY numbers is you can come in and the contract says it's offering it, but then you'll incur a cost called impermanent loss. Yeah. And that's a really important concept to understand if you're dipping your toe into these DeFi markets. Basically, each liquidity pool, in the case of Bancor or many AMM liquidity pools out there, you have two assets in the pool that are constantly getting rebalanced by arbitrageurs. So in an average pool, you would have to provide, let's say I wanted to provide my Link token to the Link pool. I would provide Link and ETH, a paired asset in that Link pool, to the pool. And now if Link really outperforms the price of ETH, and the assets diverge in value, then the automated market maker is actually selling off your link, in this case, if link rises, at a discount. And so this is something called impermanent loss. And what can happen is you will withdraw the assets, and they'll be worth less than if you had just held them alone in a wallet. So in 50-50 weights in a wallet, just Link and ETH. So this is a massive risk in DeFi AMMs, and a lot of newcomers, they see these large APY figures, but it's misleading that they're being shown that, because they're not factoring in impermanent loss.
Impermanent loss, yeah. And
so
I think even to call it impermanent loss, I think might be a bit misleading, because once you withdraw, you actually crystallize those losses. And I think we've seen a lot of that in the last couple of months, especially with ETH running away. We've seen some of the other swap tokens, the DEXs, they just didn't catch up, and ETH was just kind of running away. And that is, they typically, I mean, some of the better projects do put a small little asterisk to say that, hey, you should really understand that this is part of the APY that you're receiving is in terms of the tokens themselves, but the tokens themselves might end up becoming worthless. And that's why you get all these rug pulls, and then you get all these things, with ridiculous amounts of APY. How far do you reckon that audits could go towards, sort of, I know it can't really prevent the concept of impermanent loss, because that has to do with market forces more than anything else. But what do you see as the value of these security audits, be them community audits or be them paid audits for for the smart contracts that run these DeFis? What do you see the value behind them?
Yeah, so as you mentioned, specifically with impermanent loss, it's a natural market force. So it's not something that a technical contract audit can really prevent. Now, what we found at Bancor, and this was really Bancor's core innovation that launched about 8 months ago and has attracted billions in liquidity because of it, is we are able to insure against the risk of impermanent loss and actually fully protect LPs from impermanent loss and ensure that the capital that they put in the pool, they can always withdraw that core value of the capital and earn fees and liquidity mining rewards on top of that. So unlike any other AMM in the industry that is subject to impermanent loss, Bancor liquidity providers are not exposed to the risk of impermanent loss. And they can also provide a single asset instead of having to provide Link and ETH. In that example, they can provide just Link to the pool. And then as Link moons, as it rises, as most Link providers, most Link holders hope it will, you're 100% exposed to that upside. And then you're also getting the fees and rewards. And so the way Bancor really does that is the protocol can co-invest alongside LPs. So if you put in 100K Link, the protocol provides 100K BNT. Both sides are earning trading fees. And then if the Link stake has suffered some IL, which it always does, then the protocol can use its trading fees that it earned on its side to compensate LPs when they withdraw and compensate them for any impermanent loss that they've suffered. So impermanent loss protection and single token exposure, I think, are really two key features that we've been very excited to launch into the market, and really the only AMM that can offer these features. And we think that does a lot to add a lot of simplicity and a lot of safety and automation to the DeFi yield experience. Now, in terms of technical audits, they can go far. You want to, typically when you look at a protocol, you want to see that its version has been live for some time, that it's getting battle tested, that the contracts have been up. I'd say the age of the contracts is something that you definitely want to look at. And then yes, the number of audits that have taken place, the firms that have audited the contracts. You want to see multiple audits. There are certain scoring mechanisms. DeFi safety is one of them that looks at the contracts and the auditors. And then, as I mentioned before, no audit is bulletproof. This is let's say the Wild West of DeFi currently. So I would really recommend having a smart contract insurance cover taken out. You typically pay a percentage of the capital that you provided. So let's say provided $100,000 to a pool, you'd pay 2% of that to ensure that if there's any issues in the smart contracts or any hacks, that you're fully covered and get compensated by that third party insurance provider. And then also for the more risk-averse institutional actors, there are middleware solutions that will take custody of your assets and offer insurance directly to you. So you can just say, hey, here are my assets. I want to get those really high yields, those 10%, 20% plus yields in DeFi. Please cover me and take custody of my assets so I don't have to do it on my own. But again, going back to this issue, I think a lot of users aren't even aware of this risk of impermanent loss. And a big part of our work is educating users, what's really happening behind the scenes when you provide liquidity, how those APY figures can be misleading, and how you really have to focus on the ROI of your withdrawn capital, and the ROI of other LPs too. And we really think the answer is protection from impermanent loss to really reduce that risk that a lot of LPs can suffer.
Well, that's interesting, because you should talk about that protection from impermanent loss. It's interesting how you guys would manage that, because ultimately, somebody has to take that risk, of the IL. And if it's not the counterparty who's putting into these liquidity pools, that means it's you guys. And I'd be curious to know how you guys manage that risk.
Sure.
Especially if you're taking it on board yourselves.
Sure. So effectively what we've managed to do by allowing the protocol to co-invest alongside LPs as they put their capital in, is the protocol has effectively distributed the risk of impermanent loss across many different pools. So we have, let's say, over 200 tokens that are whitelisted on Bancor, and where the protocol is providing the other side of the pool up to a certain cap, and then generating fees from its protocol emitted BNT into the pool, and using those fees to cover the LP. And effectively what you're seeing is that while some tokens, and in our case it's paired to BNT, right? So it's not paired to ETH. So while some tokens might outperform BNT, and generate enough fee and suffer some impermanent loss, there's other in the network that are extremely profitable and are generating way more fees than the impermanent loss suffered in the pool. So you're effectively able, as a protocol, to take these profits in some pools and use them to compensate pools that are less profitable and that suffer a lot of IL. So it starts to look a lot like an insurance company, whereby the claims are measured against the premiums. So the premiums in this case generated by the protocol are the fees that it earns on its provision, whereas the claims happen, and this is very important to note, only happen when an LP withdraws its capital or their capital from the pool. And it's not like we're paying out compensation as IL is happening. IL, the reason they call it impermanent loss is because it changes based on the price changes of the tokens. So it can be very large at some point if one of the token moons, and then if the token's correct and get closer to their original ratio, it can reduce the amount of IL. So it's key that the LP is realizing this compensation when they withdraw, and also that we've managed to distribute this risk across many different pools, whereby some are super profitable, some are less profitable for us, and we're using the profits to compensate for the IL in less profitable pools when those LPs withdraw. And to date, the cost of IL to the protocol has been very minimal. It's only incurred probably, I think less than 5% of the total BNT supply has to be used to compensate for IL, which suggests that the profitability that the protocol is getting from being able to co-invest is really acting as a buffer against the IL that LPs are realizing, and providing this sort of novel experience where never before has an LP been able to really stake and forget their capital. Usually, if you know anything about AMM pools, you know what you're doing, that
you have to be very active.
You
have to be very, very active.
withdrawing it, especially in some of these new concentrated liquidity models. You have to change the pricing range. If you're too narrow, you're going to get a lot of IL. If you're too wide, you're not going to be collecting too much fees. You have to make sure you don't get bumped out of that range. So we really believe that this has to be a sort of stake and forget experience and automated for the user. And if it turns into a situation where users have to constantly maintain their stake, and they have to act, sort of very sophisticated and use all these signals in the market and all these automated tools to withdraw their stake right at the right time. Firstly, there's going to be lots of gas charges involved with constantly moving the stake around. Secondly, it creates a level of sophistication where really only the biggest and most sophisticated LPs capture most of the fees. So if you sort of reduce the incentive for the sort of smaller LPs to provide liquidity, those that don't, those that have full-time jobs, those that aren't the, sophisticated algorithmic trading firms. And if you don't do that, then all the sort of fees and rewards collect in the hands of a small amount of very active, sophisticated trading firms, as opposed to regular everyday token holders being able to participate in this new form of community source liquidity. And effectively, if you have all the gains and really all the liquidity gets centralized in the sort of hands of professional market makers, then the sort of censorship resistance of the liquidity is reduced, and you have fewer actors that are able to kind of participate in
it kind of just defeats the whole process, the whole purpose of DeFi, which is sort of like to make it accessible to everybody, to sort of like be your own bank, essentially. Because if it becomes, which increasingly it is starting to look a little bit like that right now, as the level of sophistication goes. Okay, before I let you go, we're almost up to time. I had one last question with regards to insurance. So I think insurance is not a new concept, especially when it comes to the DeFi space, but oftentimes some of the premiums actually eat away at the APYs. So, and understandably so, because, to insure these things, you have a couple of layers. First of all, you don't know if the insurer itself is a reliable counterparty. That's one. Yes, some of these insurance contracts are secured by smart contract, but then in any event, you want to make sure that your counterparty is reliable. And even in those cases where you can rely on the counterparty for your insurance, the premiums are just so high that it kind of eats away into the APY, which you're getting, which oftentimes is only momentarily high enough to cover those costs. How do you solve for that?
Yeah, so you can speak, or you can go to our Telegram and look online that and go to Bancor.network to see our rates in the rewards column and also the APR column. The rates are quite high, some of the highest for a lot of the sort of mid-cap tokens that you'll see, from Link to Matic to Aave. You'll see 10 plus, 20 plus APR rates. So we're able to still offer quite good rates. Now, again, it's not the 50%, 100% crazy rates that you'll see, but as we spoke about, those are really subject to impermanent loss, and it's sort of misleading as those protocols post those rates and to advertise them when it's really, when a user pulls out, they're actually way lower. Now, so that is our own system. Now, the third-party insurance providers has, I think it's fairly modest. I'm a user of, say, Nexus Mutual. There are some other, decentralized insurance protocols out there, but it really doesn't eat, dramatically into those rates. I think it's well worth, taking on that little 1 or 2% of your capital to cover against the risk of something bad happening. So in our case, specifically with Bancor, within Bancor, we're still able to offer those industry-leading rates, and you can, confirm that for yourself on Bancor.network. And see the rates for all those different tokens, and that third party layer is still, you're still maintaining sort of industry leading rates even with those premiums included. So I would encourage folks online to poke around Bancor, poke around the communities. I think you'll find that LPs are quite happy with the profitability of staking their tokens, and that we're able to cover this risk without, eating into rates too much.
Great, thank you. Thank you, Nathan. Thank you for taking the time to sit down and chat with us. Really appreciate your insight, and I think you've helped to shed a lot of light, not just necessarily on Bancor level, but just on DeFi in general, and what people should be looking out for, especially in terms of the automation of DeFi yield farming and stuff like that. So thank you. Thanks. Always a privilege, and I really enjoyed our chat.
Thank you, Patrick. Appreciate it.
Thank you.